Hi, I'm Rafi Plagin from Manly Financial Services. You've probably heard a bit about this intergenerational wealth transfer event that's happening right now, where baby boomers are basically passing on a lot of their accumulated wealth, a lot of their asset wealth to their children. There's many aspects that we've got to look at when we look at wealth transfer, all the way from their estate planning, their wishes, what the kids need, and also the tax implication. Now, one area that people don't know much about is in terms of transfer of wealth of superannuation. Now, when we get employer contributions put into our fund, they go under this element called the taxable element. Okay? When we make contributions personally, it goes under the tax-free element. When we pass away and we're going to pass our super to our adult children, which are children over the age of 18, they pay zero tax on the tax-free element. However, as most of our super is normally accumulated through employer and pre-tax contributions, that taxable element is taxed at 17% as it passes on to our children. So it's really important for us to consider the strategies that we can put in place before this particular event to be able to recycle some of this taxable contribution element to tax-free. So we saw a client recently on our client reviews that has a $500,000 taxable element. Now we've got to be able to devise a strategy when they do retire to be able to recycle that taxable element to the tax-free. Husband and wife will not be paying any more tax, but their kids are going to save a lot of money. So that's 17% on $500,000 by employing a withdrawal and recontribution strategy. The strategy in itself is simple in that we're withdrawing funds from the superannuation fund via the taxable and tax-free element, and then we recontribute it. When we recontribute it under the non-concessional contribution limits, it's classed as a tax-free contribution. Now, that tax-free contribution gets recycled into the tax-free element. What that will mean is that we'll be able to withdraw the $500,000 from our clients' accounts and then recontribute via the annual limits, which are $120,000 per year as a non-concessional contribution per person, or $360,000 if we do 3 years at once. And we'll be able to put a strategy together to be able to withdraw the funds and contribute the funds back in, and therefore save their kids so much tax when the untimely death occurs of both husband and wife. So it's really important to do your tax planning early, just to make sure that you've ticked that box so that no matter how much super you've got left, majority of it is in the tax-free element and not the taxable element, so that your kids save 17% tax on that taxable element. If you want some help on this, it's really important to contact us at manlyfs.com.au, book in a discovery meeting where we can look deeply into your superannuation fund, whether this is an industry fund, a retail fund, a wrap account fund, or a self-managed super fund, and find ways in which we can withdraw and recontribute the funds into the tax-free element. Please contact us at manlyfs.com.au and we'll be more than happy to take you through the strategy and save your kids a lot of tax. So it's more money for them at the end of the day when this transfer of wealth event occurs, and less money for the tax office. Take care.